Picture this. It is the early hours of January 25th, 2026. While mainstream financial outlets are still preoccupied with debating outdated inflation metrics, a tectonic fracture is occurring beneath the surface of the global commodity markets. The price of gold has quietly surged toward the $5,000 per ounce mark. But here is the anomaly. The mining companies, the very entities that hold this wealth in the ground, are trading at their lowest historical valuations relative to the metal they produce. I need you to turn off your television. Close all other entertainment tabs. Listen very closely, because what I am about to disclose is not a prediction, but an irreversible mathematical reality. We are standing before a massive liquidity trap, what Doug Casey, a legend with 50 years of frontline experience, calls the most explosive opportunity of his entire lifetime. Look at the raw data. With gold at $5,000 and all-in sustaining costs holding at approximately $1,500, producers are enjoying a net margin of $3,300 per ounce. This is not a typical growth cycle. This is a cosmic shift in free cash flow. Yet, the total market capitalization of the entire gold and silver mining sector remains laughably small. Casey provides a haunting metaphor. Imagine trying to force the entire water volume of the Hoover Dam with 7 million tons of concrete and trillions of gallons of pressure through a tiny garden hose. That is the mismatch between the institutional capital about to flood in and the absorption capacity of the mining equity market. When this pressure valve opens, what we will witness is not a simple price increase, but a physical displacement of wealth. Before I deconstruct the specific portfolio allocations and why silver is the most dangerous fracture point in this system, I want to know where you are monitoring this report from. Leave your location in the comments, whether it is New York, London, or Singapore. Knowing the distribution of silent observers helps us understand the scale of this financial awakening. Remember, the persistent premiums on the Shanghai and Dubai exchanges are proving that the West has lost its ability to price real assets with paper contracts. We are entering the takeoff stage, where $2 stocks can become legendary wealth generators once the public realizes they cannot build artificial intelligence chips, electric vehicle batteries, or defense systems with digital digits on a screen. Let's dismantle the mechanics of what Doug Casey calls the most explosive opportunity of his 50-year career. To understand why we are at a once-in-a-lifetime positioning, we must look at the mathematical spread that has never existed in modern mining history. As of late January 2026, the spot price of gold has smashed through records, trading near the $5,000 mark. Yet, the all-in sustaining costs for the world's most efficient producers have remained remarkably stable, averaging around $1,500 per ounce. This creates a net profit margin of $3,300 for every single ounce pulled from the ground. In any other industry, a 300% profit margin would trigger an immediate, parabolic revaluation of the companies involved. But in the mining sector, the market capitalization of these producers hasn't even begun to catch up. We are staring at a massive valuation gap, where the paper price of the stocks is still priced as if gold were $2,000, while the physical reality is yielding cash flows at $5,000. Casey's Hoover Dam analogy is not just a colorful image. It is a precise description of a liquidity mismatch. The total value of all gold and silver mining stocks combined is less than the market cap of a single Silicon Valley tech giant. Now, consider the sheer volume of institutional capital pension funds, sovereign wealth funds, and private equity that is currently trapped in overvalued tech and failing bond markets. As the realization sets in that real assets are the only safe harbor in a debasing currency environment, that capital will attempt to rotate into the miners. When that Hoover Dam of capital tries to squeeze through the garden hose of the tiny mining sector, the result is what Casey calls a vertical move. In the 5 major bull markets he has witnessed since the 1970s, he has seen crappy little stocks go 10-to-1 as a group, with individual junior explorers hitting 100-to-1 returns. This isn't hyperbole, it is the historical precedent of what happens when a small, illiquid sector meets a global rush for ownership. This brings us to the specific structural bottleneck in the silver market. Casey points out a reality that 99% of investors completely ignore. There are almost no pure silver miners left. 70 to 80% of the world's silver supply comes as a byproduct of mining for copper, lead, and zinc. This means you cannot simply turn on more silver production just because the price is skyrocketing. If you want more silver, you have to find and build a massive new copper or lead mine, a process that takes over a decade. We are facing a 6th consecutive year of structural silver deficits. While industrial demand from solar photovoltaics, electric vehicle infrastructure, and artificial intelligence data centers is exploding, the supply remains capped by geology. Even if silver hit $200 an ounce tomorrow, mine supply wouldn't increase meaningfully for years. This is the definition of a supply-demand trap. When institutional FOMO hits the few pure silver miners that do exist, companies with market caps often under $500 million, there is nowhere for the price to go but vertical. The leverage in the junior sector is where the generational wealth is made. These are the explorers and developers, the $2 stocks trading on venture exchanges that the public hasn't heard of yet. Casey isn't chasing the senior producers like Newmont or Barrick for his primary gains. He is hunting for the sub-$500 million names where a single high-grade drill hole or a permitting victory can double a stock's value in a week. These are companies where management often owns 20% or more of the shares, meaning they are incentivized to create real value, not just collect a corporate salary. Looking at the technicals of the GDX and GDXJ ETFs in early 2026, the signatures of a massive move are all present. After years of consolidation, volume is finally shifting. The Shanghai Gold Exchange premium over the Western COMEX price has remained persistent for over 18 months, signaling that the East is already paying up for physical delivery regardless of what the paper contracts in New York say. The arbitrage is real, and the drain on Western vaults is accelerating. We are currently in what Casey calls the early innings. The public hasn't piled in yet. The retail Reddit communities are growing, but the massive, multi-trillion-dollar institutional flows are only just beginning to turn positive. We are positioned at the base of the parabolic move, not at the top. The unresolved tension in the market right now is not if the revaluation will happen, but how quickly it will occur once the final paper illusion of the bullion banks cracks. To truly understand why the current positioning is generational, we must step back from the daily charts and examine the historical tectonic shifts that have brought us to this precipice. Doug Casey often remarks that history doesn't repeat, but it certainly rhymes, and right now, the rhythm is echoing the most volatile periods of the 20th century. We are witnessing a fundamental realignment of global power, moving away from a system of paper promises toward a reality of physical assets. To decode the future, we must first look at the 1970s. When the United States severed the final link between the dollar and gold in 1971, it inaugurated an era of pure fiat currency. What followed was a decade of stagflation, geopolitical chaos, and a gold bull market that saw the metal rise from $35 to $850. During that cycle, the mining stocks didn't just follow gold. They exploded. Those who held the crappy little stocks Casey talks about saw their lives changed forever, as the public realized that the paper dollar was losing its utility as a store of value. Today, in January 2026, the setup is even more extreme. Unlike the 70s, we now have a global debt-to-gross domestic product ratio that is off the charts. We are not just dealing with inflation, we are dealing with the potential insolvency of the entire Western financial architecture. This is why the East-West axis is the most critical part of the history profile. For the past decade, and accelerating sharply in 2024 and 2025, the central banks of the East, led by China, Russia, and the BRICS nations, have been the world's most aggressive accumulators of physical gold. They are not buying paper contracts. They are buying physical bars and moving them into sovereign vaults. This is a strategic de-dollarization play. By accumulating the world's ultimate form of money, these nations are preparing for a post-dollar world where trade is settled in currencies backed by tangible commodities. The Shanghai Gold Exchange premium that we have been tracking for 18 months is the smoking gun. It proves that the center of gravity for price discovery has shifted. The East is willing to pay a physical premium because they understand that the Western paper price is a manipulated ghost, a remnant of a system that no longer reflects the scarcity of the Earth's resources. Doug Casey's experience across 5 major bull markets allows him to identify the early innings of this transition. He points to the year 2000 to 2011 commodity supercycle as another reference point. Back then, the rise of China's industrial machine drove demand for everything from copper to silver. But what we are seeing now is different. It is not just industrial growth. It is a monetary crisis layered on top of a supply crisis. When you combine the two, you get the Hoover Dam effect. The historical profile of silver is even more dramatic. Casey often references the Hunt brothers' attempt to corner the silver market in 1980. While that was a private attempt, today we are seeing a sovereign cornering of the market. Nations are realizing that silver is not just money, it is a strategic industrial metal essential for the modern world. You cannot have a green energy transition, you cannot build advanced artificial intelligence hardware, and you cannot maintain a modern defense industry without silver. History shows that when a monetary asset is also an essential industrial commodity, the price spikes are not linear, they are parabolic. We must also consider the psychology of the public. In every major historical cycle, there is a point where the general population loses faith in the local currency. We saw it in the Weimar Republic, we saw it in various emerging markets over the last 50 years, and we are starting to see the first tremors of it in the West today. When the average person realizes that their savings are being liquidated through financial repression to pay off $34 trillion in debt, they don't buy a little bit of gold, they panic into it. As Casey notes, the retail FOMO, or fear of missing out, hasn't even begun for the mining equities. Currently, institutional ownership of these stocks is at near record lows. Most pension funds have zero exposure to the miners. They are still chasing the Magnificent Seven tech stocks, hoping for another decade of digital growth. But history tells us that when the growth story dies, capital rotates to value and safety. When those multi-trillion-dollar funds decide to move even 1% of their assets into the silver and gold miners, the garden hose will burst. We are currently positioned at the base of this historical reconciliation. The paper market has managed to suppress the truth for years through the use of high-frequency trading and synthetic supply. But as Casey's 50 years of data prove, reality eventually catches up to the ledger. The physical drain on the COMEX and the LBMA vaults is the final signal. The metal is leaving the system, and once it is gone, the paper contracts will be revealed for what they are: worthless claims on an empty vault. The revaluation of the mining sector is not merely a consequence of monetary failure. It is driven by a massive, structural transformation in global industry. To understand why Doug Casey is so confident in a 100-to-1 return on certain stocks, we must look at the physical reality of what makes the modern world function. We are moving from a digital economy built on credit to a resource economy built on atoms. In this new era, silver and strategic metals are the new oil. Let's start with the most explosive driver of demand in 2026, artificial intelligence. The public sees AI as software lines of code on a screen, but for the forensic analyst, AI is hardware. It is vast rows of servers and data centers that consume enormous amounts of electricity and require high-performance conductivity to function. Silver has the highest electrical and thermal conductivity of any element on the periodic table. As the demand for AI processing power doubles every few months, the industrial requirement for silver in high-end semiconductors and heat management systems is scaling at a rate that the mining industry simply cannot match. This is where the Hoover Dam analogy becomes terrifyingly real. According to the Silver Institute's January 2026 data, industrial demand alone is now projected to consume over 80% of annual mine production. This leaves almost nothing for jewelry, silverware, or most importantly, investment. We are looking at a market where the investment demand is competing with the industrial survival of the world's most powerful tech companies. When Apple, Tesla, or Nvidia realize they cannot produce their next generation of hardware because of a silver shortage, they won't care if the price is $50 or $500. They will pay whatever is necessary to secure their supply chains. The green energy transition adds a secondary, unstoppable layer to this pressure. Photovoltaic solar cells are currently the largest single consumer of silver. Even with thrifting technology, the attempt to use less silver per cell, the sheer volume of solar installations globally in 2025 and 2026 has negated any savings. In fact, silver loading in high-efficiency N-type solar cells is actually higher than in older models. We are projected to see solar demand alone consume 20% of the total global silver supply by 2027. Add to this the electrification of transport. An electric vehicle, EV, uses nearly double the amount of silver as an internal combustion engine vehicle. From the battery management systems to the charging infrastructure, the silver loading is non-negotiable. Casey's thesis points to the fact that you cannot print more silver to meet this demand. As we discussed in Part B, silver is primarily a byproduct. If the price of copper or zinc stays flat, miners will not increase production just to get a little bit more silver, even if silver is at record highs. The geology is a hard ceiling. Then, there is the defense component. We are living in an era of heightened geopolitical fragmentation. Precision-guided munitions, satellite communication systems, and advanced fighter jets like the F-35 are packed with silver, gold, and rare earth elements. In a conflict environment, silver is a strategic metal. A single Tomahawk missile contains kilograms of silver in its guidance and propulsion systems. As nations rebuild their stockpiles in 2026, the military-industrial complex is now competing with the solar industry and the AI industry for the same limited ounces. The field records from global bullion dealers confirm this tightness. In the early weeks of 2026, the premiums for physical delivery, the extra cost over the paper spot price, have hit record highs. In some jurisdictions, the wait time for wholesale 1,000-ounce bars is now measured in months, not days. This is what a systemic shortage looks like. It starts in the physical market and eventually forces the paper market to capitulate. Doug Casey emphasizes that this industrial demand is price inelastic. A missile manufacturer or a solar farm developer will not cancel a billion-dollar project because the price of the silver components went up by $10. They will bid the price as high as necessary to secure the physical metal. This is the trigger for the miners. When the industrial users realize the vaults are empty, they will move upstream. They will start looking to buy the mining companies themselves just to guarantee their own future supply. We are already seeing the first tremors of this. Strategic investments by automotive and tech giants into lithium and nickel mines were the first wave. The second wave, which is beginning now in 2026, is the rush for silver and gold producers. The mining equities are the only way to play this with massive leverage. A company that was surviving on $50 margins when silver was $24 is now drowning in cash when silver is $60. Their market cap may be $500 million, but they could be sitting on $5 billion worth of metal in the ground. The garden hose is already starting to leak under the pressure. The industrial demand is the constant, heavy flow of water that never stops. The investment demand, the retail and institutional FOMO is the sudden surge that will cause the hose to burst. We are positioned at the exact moment before the spray becomes a flood. The transition from a system of paper promises to a reality of physical assets is no longer a theoretical debate. It is an unfolding event that will define the next decade of global finance. As we conclude this forensic report on January 25th, 2026, the data suggests we are moving past the point of orderly adjustment and into a phase of violent systemic revaluation. If Doug Casey's 50-year career has taught us anything, it is that the greatest wealth is not made by following the crowd, but by positioning yourself exactly where the crowd will be forced to go when the exits become narrow. We are currently monitoring 3 distinct paths for the final innings of this cycle. The first is a great revaluation, where central banks are forced to officially revalue gold and silver to back existing currency supplies, sending mining stocks from undervalued to parabolic overnight. The second is an industrial hijack, where tech and defense giants bypass the exchanges to acquire mining companies directly to secure their survival, triggering massive buyout premiums for early shareholders. The third, and most devastating, is a paper market default, where exchanges announce they can no longer fulfill physical delivery, leaving digital claim holders with devaluing cash, while those with equity in the mines see their wealth multiplied. To navigate these scenarios, your positioning must be surgical. You must balance your portfolio across the risk spectrum, from Tier 1 producers in safe jurisdictions like Nevada and Australia that provide cash flow stability, to Tier 2 developers, where the 10-to-1 returns are concentrated, and finally to the Tier 3 explorers where a single discovery can trigger a 100-to-1 move. However, you must remain disciplined and account for jurisdictional risk, management competency, and timing volatility. Do not use margin, and do not use money you cannot afford to lose, because the market can remain irrational longer than you can remain solvent. Do not trust my words. Trust the weight of the metal in your hands and the cold math of the production margins. Stay focused, stay disciplined, stay safe.